Chapter 2. 9. What is accounting profession? The accounting profession is a field of work that involves recording, analyzing, and interpreting financial information for businesses, organizations, and individuals. The primary objective of accounting is to provide information that can be used to make informed business decisions, manage financial resources, and ensure compliance with relevant laws and regulations. Accountants work with financial data, preparing and reviewing financial statements, tax returns, and other reports that provide insight into an organization's financial health. They may also provide advice and guidance on financial strategy, budgeting, and investment decisions. There are many different types of accounting professionals, including public accountants, who provide services to businesses and individuals, as well as internal accountants who work within a company's finance department. Other specialized fields within accounting include auditing, tax accounting, and forensic accounting. To become an accountant, individuals typically need a bachelor's degree in accounting or a related field and may also need to obtain professional certification or licensure depending on the specific field of work they pursue. 1.0 Describe the professional ethics and rules for accounting professional. Professional ethics and rules are critical to the accounting profession, as accountants are responsible for handling confidential financial information and providing reliable financial information to their clients. Some of the professional ethics and rules for accounting professionals include integrity. Accountants are expected to maintain the highest standards of honesty, accuracy, and truthfulness in all their professional and business relationships. Objectivity. Accountants must remain unbiased and objective when preparing and presenting financial information, regardless of any personal interests or pressures from clients or other parties. Professional competence. Accountants are expected to maintain their professional knowledge and skills, staying up to date with changes in accounting standards and regulations to provide accurate and reliable financial information. Confidentiality. Accountants must maintain the confidentiality of financial information they handle, not disclosing any information to unauthorized parties without the client's consent. Professional behavior. Accountants should behave professionally, treating clients, colleagues, and other stakeholders with respect and avoiding any behavior that could damage the reputation of the profession. In addition to these general ethical principles, accounting professionals are also subject to specific rules and regulations depending on their jurisdiction and the nature of their work. For example, public accountants in the United States must adhere to the standards set forth by the American Institute of Certified Public Accountants, AICPA, including the Code of Professional Conduct. Similarly, internal accountants must follow the rules and guidelines set by their employer, which may include requirements for reporting and ethical behavior. 1.1 Define ethics. Ethics refers to a set of moral principles and values that govern behavior and decision-making. These principles and values are intended to guide individuals and groups in determining what is right or wrong, good or bad, and just or unjust in a particular situation. Ethics can be influenced by various factors, such as cultural and societal norms, religious beliefs, personal beliefs, and professional standards. In a professional context, ethics refers to the principles and values that guide the behavior of individuals within a particular profession. For example, the accounting profession has a set of ethical guidelines that dictate how accountants should behave and interact with clients and stakeholders. Ethical behavior often involves considering the consequences of actions and making decisions that promote the greater good rather than individual self-interest. This may involve balancing the interests of multiple stakeholders, such as customers, employees, shareholders, and the community, and adhering to legal and regulatory requirements. By following ethical principles, individuals and organizations can build trust, maintain their reputation, and foster a positive relationship with their stakeholders. 1.2 What is IFAC Code of Ethics? The International Federation of Accountants, IFAC, has established a code of ethics for professional accountants, known as the International Code of Ethics for Professional Accountants. The code provides a set of ethical principles and guidelines for professional accountants worldwide to follow and maintain ethical behavior and practices. The IFAC Code of Ethics consists of several fundamental principles that include integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. It also sets out detailed guidance and requirements in areas such as independence, conflicts of interest, and the provision of non-audit services. The IFAC Code of Ethics applies to all professional accountants in public practice and in business, including auditors, management accountants, and other accounting professionals. It is designed to ensure that professional accountants act with integrity and in the best interest of the public and the clients they serve, as well as to maintain the public's trust in the accounting profession. IFAC's Code of Ethics is widely recognized as a leading global standard for the accounting profession, and many national and regional accounting bodies have adopted it as a basis for their own codes of ethics. 1.3 Describe the different types of threat. In the context of professional ethics for accountants, there are several types of threats that can arise and potentially compromise the accountant's ethical obligations. These threats are: self-interest threat. A self-interest threat arises when a financial or other interest creates a risk that the accountant will not act with integrity and objectivity. For example, if an accountant has a financial interest in a client's business, they may be tempted to manipulate financial information to benefit themselves. Self-review threat. A self-review threat occurs when an accountant must evaluate their own work, which can create a risk that the accountant will not be objective or will fail to recognize errors. For example, if an accountant audits their own work, there may be a risk that they will overlook their own mistakes. Advocacy threat. An advocacy threat arises when an accountant promotes or defends the interests of a client to the point where their objectivity is compromised. For example, if an accountant becomes too invested in a client's success, they may overlook financial irregularities or other issues that could compromise their professional integrity. Familiarity threat. A familiarity threat arises when an accountant becomes too close to a client, potentially leading to a loss of objectivity or professional skepticism. For example, if an accountant has a close personal relationship with a client, they may be less likely to identify or report any unethical or illegal behavior. Intimidation threat. An intimidation threat occurs when an accountant is subjected to coercion or pressure that may cause them to compromise their professional obligations. For example, if a client threatens to terminate their relationship with an accountant unless the accountant agrees to engage in unethical behavior, this would be considered an intimidation threat. These threats can arise in various situations, and it is the accountant's responsibility to identify and address them appropriately to maintain their ethical obligations. 1.4 Who reduce these threats? The responsibility of reducing threats to ethical behavior and professional standards lies primarily with the individual accountant, as well as the accounting firm or organization they work for. In order to reduce threats to ethical behavior, accountants can take several measures, such as establishing clear policies and procedures for ethical behavior and enforcing these policies through effective internal controls. Providing training and education to accountants to raise awareness of ethical issues and ensure they have the knowledge and skills to act in accordance with professional standards. Maintaining independence and objectivity in their work, including avoiding conflicts of interest and disclosing any potential threats to their independence. Being open and transparent about any potential ethical issues that may arise, and working with clients and other stakeholders to address these issues. Seeking guidance and advice from professional bodies or other experts when faced with complex ethical dilemmas. In addition to the actions of individual accountants, professional organizations such as the International Federation of Accountants, AFAC, and national accounting bodies can also play a role in reducing threats to ethical behavior. These organizations establish codes of conduct and ethical guidelines for accountants, monitor compliance with these guidelines, and provide resources and support for accountants who face ethical challenges. Regulators and government agencies may also play a role in enforcing ethical standards and imposing penalties for non-compliance. 1.5 How do you ensure quality control within audit firm? Quality control is critical in ensuring the reliability and credibility of financial information that is audited by an audit firm. There are several steps that audit firms can take to ensure quality control, including establishing quality control policies and procedures. Audit firms should have clearly defined policies and procedures for maintaining and monitoring quality control, including identifying and addressing potential threats to independence and objectivity. Assigning appropriate personnel. Audit firms should ensure that the appropriate personnel are assigned to audit engagements based on their level of experience and expertise in the relevant industry. Providing adequate training and professional development. Audit firms should provide their personnel with ongoing training and professional development opportunities to ensure they stay up to date with changes in accounting and auditing standards and maintain the necessary skills to conduct high-quality audits. Implementing a system of peer review. Audit firms should have a system of peer review in place to ensure that their audit work is subject to rigorous review by other experienced auditors, both within and outside the firm. Conducting regular internal inspections. Audit firms should conduct regular internal inspections to monitor the effectiveness of their quality control policies and procedures, identify areas for improvement, and take corrective action as necessary. Encouraging a culture of ethical behavior. Audit firms should foster a culture of ethical behavior, including maintaining independence and objectivity, and adhering to professional and ethical standards. Implementing technology-based solutions. Audit firms should adopt technology-based solutions to support quality control measures, such as data analytics, artificial intelligence, and other tools that can help to automate and standardize audit processes. By implementing these and other quality control measures, audit firms can help to ensure that their audit work meets high standards of quality and contributes to the reliability and credibility of financial reporting. 1.6 Describe the threatening auditor integrity and independence. The integrity and independence of auditors are critical components of the auditing process, and any threats to these attributes can undermine the credibility and reliability of the audit work. There are several factors that can potentially threaten auditor integrity and independence, including financial interest or self-interest threats. Auditors may have a financial interest in a client, such as holding stock or receiving bonuses based on the client's financial performance. This can create a self-interest threat that could compromise the auditor's objectivity and independence. Familiarity threat. Auditors who have a long-standing relationship with a client or who have personal relationships with client personnel may be at risk of a familiarity threat, which could compromise their objectivity and independence. Advocacy threat. Auditors may be at risk of an advocacy threat if they become too involved in promoting or defending the interests of a client, to the point where their objectivity is compromised. Intimidation threat. Auditors may be subject to intimidation threats if they are pressured or coerced by a client or its management to engage in unethical behavior or overlook irregularities in the financial statements. Self-review threat. Auditors may be at risk of a self-review threat if they must evaluate their own work, potentially leading to a loss of objectivity and professional skepticism. These threats can arise in various ways, and it is the responsibility of auditors and audit firms to identify and address them appropriately. Auditors should take steps to ensure their independence and objectivity, such as avoiding conflicts of interest, maintaining appropriate levels of professional skepticism, and disclosing any potential threats to their independence. In addition, audit firms should have clear policies and procedures in place for maintaining independence and addressing potential threats, and should conduct regular internal inspections to monitor compliance with these policies. The audit profession is subject to strict ethical and professional standards, which aim to maintain the integrity and independence of auditors and ensure that their work contributes to the reliability and credibility of financial reporting. 1.7 How auditor match his professional work and conflict of interest. Auditors have a professional responsibility to maintain independence and objectivity in their work, and to avoid conflicts of interest that could compromise the credibility of the audit. In order to match their professional work with the need to avoid conflicts of interest, auditors can take several steps, including identifying potential conflicts of interest. Auditors should be vigilant in identifying potential conflicts of interest, such as financial interests in the audit client or close relationships with client personnel. Maintaining independence. Auditors should take steps to maintain independence and objectivity in their work, such as avoiding financial or other interests in the audit client, refraining from providing non-audit services that could compromise independence, and maintaining appropriate professional skepticism. Disclosing potential conflicts of interest. Auditors should disclose any potential conflicts of interest to the client and other stakeholders, and take steps to mitigate these conflicts or withdraw from the engagement if necessary. Following professional standards and guidelines. Auditors should follow the ethical and professional standards set out by their regulatory bodies and professional organizations, which provide guidance on maintaining independence and objectivity in the audit process. Establishing and following firm policies. Audit firms should have clear policies and procedures in place for identifying and addressing potential conflicts of interest, and should ensure that their personnel are aware of and follow these policies. Seeking guidance and advice. Auditors can seek guidance and advice from professional organizations or other experts when faced with complex ethical dilemmas or conflicts of interest. Overall, auditors must be vigilant in maintaining their independence and objectivity, and take proactive steps to identify and address potential conflicts of interest. By adhering to professional standards and following firm policies, auditors can help to ensure that their work is conducted in a manner that upholds the integrity and credibility of the audit process. 1.8 Describe the matter related to auditing profession like 1. Advertising and publicity 2. Remuneration 3. Inside dealing. Advertising and publicity. The auditing profession is subject to strict rules and guidelines when it comes to advertising and publicity. Auditors are generally prohibited from making false or misleading statements about their qualifications or experience, or from making claims that could be construed as guaranteeing their work. They must also avoid any statements or actions that could damage the reputation or credibility of the auditing profession as a whole. Remuneration. Auditors must be compensated fairly and reasonably for their work, but they must also avoid any conflicts of interest that could arise from excessive or inappropriate remuneration. They must ensure that their remuneration is based on objective criteria and that it does not compromise their independence or objectivity in the audit process. Auditors are generally prohibited from accepting contingent fees or fees based on the results of the audit, as these could create conflicts of interest. Inside dealing. Auditors must avoid any actions or behaviors that could be seen as insider dealing, which involves using confidential or privileged information to gain an unfair advantage in the marketplace. Auditors must maintain strict confidentiality and privacy when handling client information, and they must avoid any actions that could be seen as trading on that information or sharing it with others. Auditors may be subject to legal and regulatory action if they are found to have engaged in insider dealing or other unethical behavior. In summary, the auditing profession is subject to strict rules and guidelines related to advertising and publicity, remuneration, and inside dealing. Auditors must be vigilant in adhering to these rules and guidelines to maintain the credibility and integrity of the auditing profession and to ensure that their work is conducted in a fair and ethical manner.